Every fraud in this video was audited. Every company had accountants sign off on the books. Every CEO told shareholders the business was sound. The numbers were wrong. All of them. Here are 7 accounting frauds that wiped out millions of ordinary people. Accounting fraud is the most sophisticated crime in the world. It requires expertise, patience, and institutional cover. And in almost every case, it requires regulators who are not paying attention. These are 7 cases where the numbers were lies, and the people who told the lies made billions. Starting with number 7. Number 7. WorldCom. At its peak, WorldCom was the second largest telecommunications company in America. Between 1999 and 2002, executives took $11 billion in operating costs and reclassified them as capital expenditures. This is not complex financial engineering. This is changing one number to another in an accounting ledger. The fraud inflated profits. The share price rose. Executives exercised stock options worth hundreds of millions of dollars. When the fraud was discovered in 2002, WorldCom filed for the largest bankruptcy in American history at that time. 41,000 employees lost their jobs. Shareholders lost $180 billion. CEO Bernie Ebbers was convicted and sentenced to 25 years. He served 13, released early due to health concerns. He died 4 months later. Number 6. Theranos. Elizabeth Holmes told investors, regulators, and patients that Theranos had developed technology to run hundreds of medical tests from a single drop of blood. The technology did not work. Theranos ran most of its tests on standard commercial equipment from other companies, the same machines available to any certified laboratory. Patients received false results. Some were told they had HIV when they did not. Others that they did not have conditions they did. Theranos raised $945 million from investors including Rupert Murdoch, Betsy DeVos, and the Walton family. The company was valued at $9 billion. Holmes was convicted of fraud in 2022. She was sentenced to 11 years. Patients who received false test results received no compensation. Number 5. Wirecard, Germany. Wirecard was a payment processing company, a member of the DAX 30, Germany's most prestigious stock index. For years, financial journalists and short sellers raised concerns about Wirecard's accounts. German financial regulators responded by investigating the journalists. In June 2020, Wirecard admitted that 1.9 billion euros, roughly a quarter of its total assets, did not exist. It had never existed. The company filed for insolvency within days. CEO Markus Braun was arrested and is awaiting trial. Chief Operating Officer John Marsalek, who oversaw the accounts where the money was supposedly held, fled Germany. He is believed to be in Russia. He has not been found. Number 4. Bernie Madoff. For approximately 40 years, Bernie Madoff operated the largest Ponzi scheme in history. He never invested a single dollar of client money. He simply paid earlier investors with money from new investors. His clients included banks, hedge funds, charities, pension funds, and individuals across America and Europe. The scheme continued for 4 decades, through multiple market crashes, regulatory reviews, and SEC investigations. The Securities and Exchange Commission investigated Madoff 8 times. 8 times, they found nothing. A financial analyst named Harry Markopoulos submitted detailed mathematical evidence of the fraud to the SEC in 2000. He was ignored. He submitted it again in 2001. Ignored again. When the scheme collapsed in 2008, $65 billion was gone. 37,000 clients in 136 countries lost money. Many lost everything. Madoff was sentenced to 150 years. He died in prison in 2021. The SEC employees who cleared him 8 times faced no disciplinary consequences. Number 3. Enron, Houston, Texas. In the late 1990s, Enron was named America's most innovative company by Fortune magazine. 6 years in a row. Its executives were creating hundreds of shell companies, entities that existed only on paper, to hide debt and manufacture profit. The reported revenue was real enough to fool analysts, regulators, and auditors. The underlying business was collapsing. On October 16, 2001, Enron announced a $618 million quarterly loss. Within weeks, the full scale of the fraud was apparent. Enron filed for bankruptcy on December 2, 2001. It was the largest bankruptcy in American history until WorldCom the following year. 20,000 employees lost their jobs. Most of them had their retirement savings invested in Enron stock. That stock was now worthless. Shareholders lost $74 billion. CEO Ken Lay was convicted. He died before sentencing. CFO Jeff Skilling served 12 years. The accounting firm that signed off on Enron's books, Arthur Andersen, was criminally convicted and destroyed. 90,000 Arthur Andersen employees, most of whom had nothing to do with Enron, lost their jobs. Number 2. 2008. The entire Western financial system. Between 2004 and 2007, major investment banks packaged millions of high-risk mortgages into financial products called collateralized debt obligations. Rating agencies gave these products their highest possible credit rating. In some cases, the same banks selling these products were simultaneously betting against them. Internal Goldman Sachs emails from this period describe the products they were selling to clients as, and this is a direct quote, a shitty deal. They sold them anyway. In 2008, the entire structure collapsed. The US government bailed out the banking system with $700 billion of public money. In Europe, governments spent over 1.6 trillion euros on bank rescues. 8 million Americans lost their jobs. Millions lost their homes. The global recession that followed lasted years. In the United States, one senior banker went to prison for his role in the crisis. 1. His name was Karim Sarageldin. He was a mid-level executive at Credit Suisse. The executives who designed, approved, and sold these products kept their bonuses. Number 1. This is not one company. This is a system. In 2016, an anonymous source leaked 11.5 million documents from a Panamanian law firm called Mossack Fonseca. The documents became known as the Panama Papers. They showed how law firms, banks, and accountants across America and Europe had spent decades helping politicians, executives, celebrities, and royalty hide money in shell companies across the world. Money hidden from tax authorities. Money hidden from creditors. Money hidden from courts. The leak involved 214,000 shell companies, clients in 200 countries, including 12 current or former world leaders. The documents named banks from Germany, Switzerland, the United Kingdom, and the United States as key facilitators. Many of the structures used were entirely legal, because the people who wrote the laws were often the same people using them. In the years since the Panama Papers, over $1.2 billion has been recovered by governments worldwide. Prosecutors estimate the total amount hidden runs to trillions. Mossack Fonseca closed. The system it served continues. The anonymous source has never been identified. 7 frauds. 7 sets of audited accounts. 7 companies that told the world their numbers were real. Combined losses to investors and workers, over $300 billion. Prison sentences served by the top executives responsible, under 30 years total. Bonuses paid to the executives who designed the frauds, in the hundreds of millions. The accounting firms that signed off on most of these books still exist. The regulators who cleared them still operate. The system that made this possible has not fundamentally changed. No one goes to prison. And next quarter, business continues. This is what Guilty and Free documents. Real cases, verified facts, no arrests. Next week, the pharmaceutical company that created an epidemic and kept every dollar. Subscribe. We have a lot more to show you. They got away with it, but not with you watching.